Hey guys, Sean here. So we have finally reached 8.5% inflation, the highest since 1981, and the signs were obvious, right? A combination of money printing, supply chain issues from the Ukraine war, and sanctions backfiring. I've warned about it in my previous video, and if you want to keep it real, inflation is much higher than that carefully engineered CPI number. Now, the way I see inflation is simple, right? Food, energy, and electricity prices. We need these three to survive, and to me, that is the real cost of living. And if you take a look at the individual CPI numbers for these categories, we get a 10% increase for food, 32% increase in energy, and an 11% jump in electricity prices. Now, the big question is what happens next? Obviously, everyone is concerned, and I have no doubt that the government is going to pressurize Jerome Powell to do something. Now, the Fed has signaled that they are going to go full steam ahead with combating inflation, and that means a two-pronged approach, right? They want to flank inflation from both sides and hope to survive. They are going to continue the rate hikes. Remember, they jacked it up by 25 basis points in March, and this time they could raise interest rates by 50 basis points. Plus, this time they are most definitely going to go ahead with quantitative tightening and reduce their balance sheet by $95 billion a month. And in this video, we are going to investigate what this means going forward for the economy and for us. Now, the big issue with jacking up rates and reducing the money supply is the sudden shock it can really cause the economy. Remember that the economy is still incredibly leveraged today, and we are on a high from low interest rates, cheap money. And while the Fed is going to reduce its balance sheet, we are still a long way to go from 8.9 trillion down to 4.1 trillion before they decided to print money in 2020. Now, Powell has come out to say he's aiming for a soft landing where there's neither recession nor high unemployment. And I honestly think that is delusional talk, right? Because he's comparing it to the tightening cycles of 1965, 1984, and 1994. But that was before the great era of quantitative helicopter money printing. And I really think we are at a unique point in time in history where we could see the stock market and economy crashing, but inflation might still be sky high when it comes to the things that we need to survive, right? I'm talking about gas in our tank and the food in our bellies, and this could really cause consumer spending to change. Because at the end of the day, what is more important? Your stock portfolio stuffed with the S&P 500, that holiday that you booked to Europe, or trying to set aside money so that you don't starve. At this point, I think the decision has become more binary, right? We could be seeing consumer spending drain away from the non-essentials to the essentials such as food, and this could spark a situation where we see a deflationary crash in certain assets while inflation is still disgustingly high for the things that we need. The big issue with inflation is that it's not only been fueled by money printing over the last few years, so just draining away the money supply might not be enough. There are serious supply chain issues going on in the world, and we are seeing crazy food riots erupting in Shanghai, China. Food and fuel prices are soaring in Pakistan and Peru, and this is one of the core triggers that sparked the Arab Spring back in 2010. When people can't eat, they get angry, and when they get angry enough, they riot. And you might be thinking, right, isn't price controls a solution? Now, the big problem with that is that it just opens up a whole new can of worms, right? People will be spending all their money to hoard food because there will be even more shortages, business will be operating at a loss and even shut down, and black markets could really start popping up here and there, and this could easily spiral into a recession. A lingering question that keeps resurfacing is what the Fed will do if they raise interest rates and suck money out of the system when the stock market looks shaky, right? What would the Fed do? And this is the big issue we have because the Fed has a real bipolar dual mandate that could really cause them to overreact one way or the other. Since 1977, the Fed was given a dual mandate by the government to specifically accomplish two things: maximize employment while stabilizing prices, and to accomplish that, they use interest rates. Now, the big issue is that you cannot affect one without causing harm to the other. If you increase interest rates high enough, yes, you will stabilize prices, but companies will find it harder to borrow money to grow, existing debts will get harder to repay, and that means businesses will start firing people and layoffs might happen. Now, in the past, the Fed had the balls in the form of Paul Volcker, who truly didn't care what people thought about him, and jacked interest rates to nearly 20% in 1981. Yes, it sure as hell stabilized prices and fought inflation, but it sent unemployment soaring to 11%. Now just imagine, 1 in 10 people were virtually unemployed. And the big issue with the Fed today is that they are more concerned about maximizing employment than fighting inflation, right? We can see that ever since 2008, to help the economy recover from the crash, and instead of letting nature take its course, they printed money and lowered interest rates. And the same thing happened in 2020 when the lockdowns happened and people started to lose their jobs. What did the Fed do, right? They handed out stimulus money, increased the money supply, and slammed down rates again. And this time, it might not be so different if we do see a market crash. There are very shocking reports from the Pew Research Center that over 50% of US households are invested in the stock market. And if suddenly half of the population sees their wealth just evaporate, do you think they will vote for the current administration? And this is why it's very possible that if tightening causes the markets to crash, we could see the Fed start to pump money back into the system again. Plus, if we take a look at the national debt, which is sitting at a horrific $30.3 trillion, there's only a limit to how much interest rates can be raised before making these payments are near impossible. We need to watch what Powell does, because if he decides to reinflate the economy again, we could be hit with a double wave of inflation. Right now, the war between Russia and Ukraine is causing a lot of shortages that could lead to a food crisis. These are the breadbaskets of the world, accounting for over 25% of wheat exports and 70% of sunflower oil production. But the worst part is the fertilizer shortage that's going to impact harvests down the road around the world, right? These are some of the true consequences of the sanctions imposed on Russia. When you sanction a commodity-rich juggernaut like Russia, there are going to be blowbacks, and we are seeing it in the current currency war between the dollar and the ruble. But more importantly, in our food and energy prices, it's really inspiring to get on your soapbox and try to sanction Russia back to the Stone Age, but it will be common people like you and me who will suffer the most. And the big issue with rising food and energy prices is that suddenly everything else becomes non-essential. We already know the income pie, right? 30% goes into housing, 20% goes into food, and 10% goes into gas, and so on and so forth. But if suddenly a big chunk now has to be allocated for you to survive, a lot of bad things can happen, right? You won't want to buy that big house anymore, say goodbye to shopping for new clothes, and you and the kids won't be visiting Disneyland for quite some time. And just this change in consumer behavior alone will pull cash flow for one sector of the economy into another, and this could trigger a recession for certain sectors of the economy. Now, there is a possibility that we could see the mother of all crashes happening if the Fed goes through all the way with their plans. Right now, we can see the stock market starting to shake a bit after essentially doubling since the start of the funny money printing back in 2020. And if that happens, we could be in for quite a nasty fall, and even for gold and silver as well. But guess what, guys? I am still buying gold and silver because there could also be a scenario where money could just leave the over-leveraged stock market and just flood into precious metals. We are seeing gold prices just fly up, almost touching 1980 upon reception of the 8.5% inflation news. I believe gold is still an effective inflation hedge, but it will take some time before people start piling into the metal. It happens slowly and then suddenly. We just need to rewind back time to the Weimar hyperinflation of the 1920s. If you take a look at the chart of the paper marks against the gold mark, you can see it took quite some time for the build-up of the paper currency to really take effect before that big move up. And it seems that gold and silver are always lagging when it comes to performing in a time of money printing. So there could be a period where gold and silver still does nothing while inflation continues to reach on and on. But when the time comes for prices to spike, I think that the move could be explosive when people start piling into the markets. But mind you, I am talking about the physical gold and silver markets, right? The physical stuff where you need to pay premiums to get your hands on it, because that is the only type of precious metals that matter. We know that the paper markets are incredibly huge compared to the real physical markets, but I still expect prices there to also rise. So right now, we need to watch closely what the Fed does, because if Powell attempts to tighten all the way, the markets could crash. It's very likely we could have a crisis or recession on our hands, and gold and silver might also take quite a tumble, and I think it could be a good time to pick them up at a discount. Stocks will be cheap as well as precious metals. And one indicator I'm monitoring keenly is the S&P 500 to gold ratio, which shows me if gold is overvalued or if it's the S&P 500 that is overvalued. And from what I can see, it shows that the ratio is narrowing and there could be a time to take some gold and convert it into cheap stocks when equities revalue to their true level once the cheap money leaves the system. But for now, I still want to be holding lots of silver and lots of gold, right? And the big issue is that we won't know how bad April's inflation numbers will be and how the war between Russia and Ukraine will evolve. Will the energy and food crisis get worse? Will more money be borrowed or printed to keep the war effort going? How much more debt is going to be stacked on top of that $30 trillion? Now, all these are important questions that we need to ask ourselves. We could see precious metals continue to move up past $2,000 and even $2,500. And if a crash happens, the low of the metal price could be higher than the previous level of $1,800. A lot of economists and mainstream media are calling for peak inflation. They believe we will cap out 8.5%, but something tells me that might be wishful thinking, because if inflation starts to peak again in April and then peak again in May, this is where I think panic will start to set in, and we will see a rush towards tangible assets such as gold and silver. Plus, at that point, people could really start stockpiling food and supplies as well. So what am I doing right now? I am continuing to buy gold and silver in case inflation continues to heat up. There's no change in that, but I'm also stacking some more cash as well in case a bubble pops when the Fed aggressively tries to fight inflation. You know, I have no idea if it will be the stock market crash that triggers it. It might be housing prices as people just give up after being priced out of the market for so long. But I do know that consumer behavior will change and money will be flowing from non-essential assets into a thing that we need to survive, mainly food and gas. So I'm pulling out some physical cash and just waiting for something to happen. If the war suddenly ends next week, I'll just be grabbing more gold and silver at a discount because the fundamentals are still strong, nothing has changed. If equities fall even more rapidly and we see a '08 style crash, then I'm picking up more value stocks there as well. I think the big moves in gold and silver still aren't happening yet. Strangely enough, people are still believing that the Fed will come to save the day, but history has shown us that they will overreact. Price stability seems to be an afterthought when it comes to the economy today. It's all about ensuring job unemployment is low, and if prices rise, you just print more money and give more free money, right? Right now, there are serious discussions about giving people gasoline stimulus checks, and if this extends to food, this is when panic will set in. So let me know what you think. Do you think the Fed will crash the markets and then start printing money all over again? Let me know in the comments, guys. And if you enjoyed today's video, be sure to smash the like button and subscribe for more gold, silver, and finance videos. Thank you all for watching, and I'll see you soon.